The yield curve reflects market expectations for how fast the Federal Reserve is likely to raise interest rates, based on expectations for economic growth and inflation. An inverted curve, short-dated bonds offering greater nominal returns than their longer-dated peers, is often interpreted as a signal of a looming recession. But there are different ways to interpret a flattening curve, depending on how it comes about. For most of this year, both short and long-term bond yields rose as government bond prices fell across the board. However, yields on bonds due in less than 2 years rose quickest. The pattern indicated both the short and long-term growth outlooks had improved, leading investors to expect more interest rate increases both now and in the future. That is no longer true. Now, the yield curve is closer to inverting not because short-term economic indicators are improving, but because longer-term rate expectations are falling. The Treasury Building in Washington. Photo, Bill Clark/CQ Roll Call/Newscom/Zuma Press. This quarter, yields on longer-dated bonds have dropped and those on 2-year Treasuries are flat. The gap between 2 and 10-year Treasury yields is now around 0.11 percentage point, compared with around 0.55 percentage point at the beginning of the year. When it comes to an inverted yield curve, anyone who ignores its economic message should do so at their own peril, said Paul Hickey, co-founder of Bespoke Investment Group. As far as the market signal and the ultimate timing of any downturn that follow an inverted yield curve is concerned, things are a lot trickier. The Dow Jones Industrial Average fell nearly 800 points and bond yields plummeted on Tuesday as investor doubts over the U.S.-China trade truce renewed anxieties about the pace of economic growth. More write to Mike Bird at mike.bird@wsj.com.